Okay. Hi, everybody. This is in the latest edition of, I don't even know what I call it, Random Walks, New and Interesting in Capital Markets. I'm very happy to have with me my good friend John Lehr. I'm going to read John's bio from his website. John is a co-founder of the venture capital firm Workbench, which, where do you describe Workbench here? Let's call it enterprise series. Well, I don't know, you just quickly describe it and I'll get back to your bio.
Enterprise seed fund based in New York City.
Enterprise seed fund based in New York City. Prior to Workbench, John worked at Morgan Stanley at the office of the CIO. He partnered with internal technology clients to facilitate the selection and onboarding emerging technology startups. John is a graduate from Penn, where he played a lot of basketball with me, and he received, that's basically his crowning.
The important part, right?
Yeah. Absolutely. And you have, I didn't actually know you had a degree in bioengineering with minors in math and econ. Anyway, yes, John's great, and he just raised a new fund, and which is quite the accomplishment, and especially in this climate. And so why don't we start with that? What is the new fund for? What are you guys doing? What's the thesis? And then I'm going to ask you how the process was and how it's changed, and et cetera, et cetera. Go ahead.
For sure. Excited to get into it, and thanks for having me. So the cool part about what's new is it's a lot of what's the same. So one of the things my co-founder Jess and I are proudest of with this new fund, which is a $160 million seed fund that we just announced last month, is that 12 years ago we made an early bet that New York should have a thriving enterprise hub. We figured we have 52 of the Fortune 500 based here, all the early adopter buying industries, across financial services, pharma, media, and we figured why would there not be a robust startup ecosystem so that startups could build and sell near their clients, near their ultimate customers. So that bet has thankfully played off, and we still have a very big New York focus, although we do invest really across the country, and also we have some pockets in Israel and the UK. But the other big thing that we've done really since day one that has been unique to us is we tried to flip that existing VC model 12 years ago, where most Silicon Valley firms would start with the tech. They would hang out at Google, at Facebook, looking for the next thing, fund it, and in the enterprise then lob it to places like the big banks, where it was often a square peg in a round hole. What we've tried to always do is be thesis driven. So in the enterprise, you have pain points, you have budget dollars, you have priorities. We figured instead of trying to buy a lotto ticket, turn enterprise investing into a game of 3D chess of sorts. So we actually start with the buyers in our backyard, try to figure out what is top of mind in things like machine learning. Back then it was big data, right? Then it was ML, now it's AI, of course, and things like cloud, developer tools, cybersecurity, application layer stuff, and really try to develop themes that will then publish on our blog. We'll host community events around it to find the best entrepreneurs, and then we'll look for those folks, ultimately the entrepreneurs who are building in those spaces, and connect them with the customers rather. So in that process, the Fortune 500s are getting, and now even increasingly some of these late stage tech companies are getting curated intros to people that could solve their pain points. The startups are getting oxygen, curated intros to the right people at the right time, which is really impactful. And for us, on top of all the other diligence that a seed fund will do, team, product, market, etc., we now have voice of the customer feedback layered in. So that was an early bet. We continue doing that to this day. Of course, profiles of the founders have changed, profiles of early adopter buyers have changed in some ways, but in some ways they've also stayed the same. So things like financial services, a lot of people get nervous around them, but for many industries they can actually be early adopters. Once you unpack the difference between something like a big bank versus a regional bank versus a PE versus a hedge fund, there's actually a lot of nuance that you can work with. But as we just zoom out a second and think about that $160 million seed fund, we're taking a concentrated approach to portfolio construction since day one. The first few funds were 20 deals. We'll probably do something like closer to 24 in this fund. And we work very closely with our companies post-investment on really all things go-to-market. That is like the main thing that we're known for, that 0 to 1, everything from nailing your messaging, defining your ideal customer profile, which is really critical, helping with some of those early customer introductions and back channels, and then helping you build pipeline and hire your first salesperson and beyond.
So that's interesting. So just like to pick on a few pieces of that, right? Like back when you started, selling into enterprise was the death, right? Like, especially for like the move fast and break things generation, you try to show up and, in enterprise for various reasons, both relative lack of sophistication, but also just like not understanding the internal bureaucracy and, whatever it might be. Has that changed at all? Like, I feel like, first of all, startups have become much more ubiquitous. Even some of the large enterprises, like I always joke that, the best fintech around is JP Morgan. And it's half a joke. They are really good at building technology, even consumer technology, relatively speaking. Has it changed at all? Like, are enterprises getting any better to sell through or no?
So I would say the answer is yes and no. So like JP Morgan, as much as they build, they are the second customer for several of my startups over the last decade, right? I would say, again, I want to really make a distinction between FinServ, pharma, life sciences, and media. Those three industries have historically been early adopters. If we take something like retail, they've actually been a horrible customer for early stage companies. They have EPS pressure. They don't always have the talent to deploy the tech. There's blackout periods, which makes sense for their business around like things like the holidays. So it's actually very tough to sell in. You look at something like telco and energy, they don't have like even the sophistication sometimes to evaluate the tech. So they make more sense if like Insight invests in a company in a growth round, multi-$100 million round. Sure, Insight has their BD arm that can help you with those kind of introductions, but really navigating the banks to walk through that example you're giving, JP Morgan may be looking for early stage stuff in identity for, agents. I'm making this up, of course, right? And then Morgan Stanley may be looking for early stage stuff in security or cloud. And then a hedge fund may need something cutting edge of ML. So really appreciating the nuance within each of these giant institutions. One big bank or one hedge fund could be good at buying as an early adopter client one type of technology, but you should stay away in 4 other categories, either because they built something in-house, they have incumbents that are getting the job done. So the reason we're here in New York, and we have such active engagement with the buyer community is to understand what's going on, understand who's raising their hand for something early, and then be able to help really be matchmaker or develop a theme in that space.
Do you have a sense that, like, do the enterprise themes, are they enduring enough? Because the other part, obviously, is like, which can happen in the enterprise sales cycle, is like things get buzzy. Executives have lots of incentives to kind of say, oh, we're working on this, we'll get on it. But like most of this stuff dies on the vine and they move on to the next thing. And that's kind of how they, they're professional information absorbers, right? That's mostly what they do. But they rarely actually like decide to move. Is that a fair criticism or no?
It's 100% fair criticism, and it's where there's a lot of art, but also science in our model. We're trying to find and invest 12 to 18 months out. If there's a pain point today that they're talking about and we don't have a company in that space, it's too mature, right? So we cannot invest in something today in the hopes that as a seed stage company, they can solve that active pain point. But when we're looking 12, 18 months out, we're really trying to hit that bullseye of, all right, you're going to build, and as you mature, they have that pain and they can probably engage with you either as a design partner or ultimately a customer, and you can get that timing right. I'll be candid. We do a really good job, I think, with markets, but ultimately as a seed investor, you can never be 100% with timing. So that is where we try our best, and you get multiple data points. And we also try to go cross industry. So, in the early days, people would ask us, are you a fintech investor? You come out of Morgan Stanley. And I said, no, I'm an enterprise investor. We at Workbench are enterprise investors. Financial services is one of the early adopter buyers. But when we're doing something like security, we're going to take that company then to a big pharma like a J&J. We're going to take them to a media company like Bloomberg, who's an early customer of one of our security startups, right? So when you can at least get cross-industry adoption, knowing there's a pain, that's where we get that thesis, and you can try to pull a cord there. Again, not 100%, but that's the key to our model.
And this is also, I think, something that sometimes gets lost in translation a little bit. Like with enterprise is different than, say, B2B, right? Like, in other words, these are not point solutions. Like, it's almost like you talk about being a design partner. Like, for a lot of companies, like if somebody says, if a big org comes and says, hey, be a design partner with us, that's like run screaming from the hills, because that just turns into a very expensive consulting arrangement. Like, that's not what this, or I guess that is still probably a trap that enterprise companies can fall into, but that's different, right?
There's plenty of traps like that, and even with the best intentions from the corporate side or from potentially other investors, sometimes when they make intros, you would hope that it's not going to be that, but you can kind of die from the bear hug of too much, engagement with a single customer if they alter your roadmap. So again, there's a lot of nuance in how to handle that and having multiple conversations with other folks. But to your question on enterprise versus B2B, it's so funny. The nomenclature is all over the place. We invest in companies that sometimes day one will go big banks, for instance. We invest in companies that will sell to other startups, and then go to big tech companies, and then go to the Fortune 500. One of my companies, Fire Hydrant, was like that, right? In the incident management and alerting space. So for us, it doesn't matter if day one you're going big enterprise, but we just want to know that there's a path, because ultimately, part of my conviction is that to build an enduring business, you need Fortune 500 in your customer base. And during ZIRP, I think that was one of the biggest mistakes that people made, where they just said, oh, screw the old guard, they're slow, they're stodgy, tech is the future. And all of that churn that happened in 22, 23, when big tech companies either, chose open source versus commercial offerings, when they reduced headcount and all those SaaS seats got significantly dropped, right? There was a lot of pain that was felt during that reset moment. And again, the fun and challenge of why 12 years in I'm always so fired up is because there's no easy answer. It's not like saying go enterprise is the solution either, because it's complicated as all hell. And, your champion can leave after a long time, or you could have some, big thing that you think's going to hit and you had happy ears. So there's a whole lot of messiness in that world, but that's where we think we can help have an edge ourselves and support our entrepreneurs to break out from, their competition.
But I guess part of Nader's leading question was like, and maybe I'm wrong about this, but like, isn't the kind of the burn cycle, I guess, for an enterprise, it's a little different, right? Because it's not like they can hit revenue that quickly, certainly not profitability. Like the expectation is that these are going to be, just by nature of the sale and the complexity of the build, they're going to be burning money for a while. Right?
Yes. By the way, it's a really important nuance you bring. So there's two elements to it. Number one is the profile of an enterprise, and especially an infrastructure company, is different than something at the application layer, right? Especially if they're going, to your point, like B2B and can get rapid customer adoption, maybe even $1 million plus before even a seed round, I'm hearing these days, right? Which is why for some of the more hardcore infra, security, dev tool stuff, we want to make sure, first of all, that we have a point of view on the space and why we think it can ultimately be huge. We also, as an investor, as part of helping these companies, need to help understand and work with them to figure out what will those milestones be for the Series A, for the Series B, etc. It's going to be quite different. Who are the players? Who are the specific partners at some of these bigger firms that do enterprise? What are they going to want to see? And where do we think reality is kind of in between of what you're able to hit? So the benchmarks are quite different. Sometimes it's a few customers. Sometimes it's, a very big ACV. Sometimes it's more of a handful, but in that mid stage of ACV where you can show a land and expand motion. So each and every company that we're doing actually is quite different. So you can't just say, get this much of ARR and you're going to get this many customers, because the nuance of the competition, is it greenfield versus red ocean? Is there, do you have 5 peers going after the low end of the market? You're going high. There's just so many different machinations you can play out. And it's why we're so hands-on with our companies, to just make sure that they're informed of what are the expectations, how can we help them hit it, and really accelerate that time to showing that customer adoption, which ultimately is the most important metric.
Interesting. And you also, I guess, on the benchmarks point, do you even really know what those are right now, given how the financing climate has changed, right? And the sort of premium that's being put on sustainability, not necessarily capital consumption, where it's almost like, which makes sense, I think, for a lot of startups, that they should be building real businesses sooner. But enterprise is a little different, because of the nature of what it is that they're trying to do. Are A's getting done? In other words, do you even have a sense of what those benchmarks are or at least ought to be? So I'm sure you have a sense, but yeah.
Yeah, it's without having it as a cop-out answer, for more traditional SaaS type deals, which is a big chunk of our portfolio. My co-founder Jess does our application deals, right? Her and our colleague Danny will do surveys to a lot of our Series A network and figure out all right, for the next 6 months, what are you seeing in terms of growth? What are you seeing in terms of ARR thresholds? What else is important? Are you looking at things like gross margin? Are you looking at things like deployment time, right? For companies that are a little bit older, even things like renewals and things like that, any sense of retention or usage. So we're trying to be data-driven when possible there. And, I think even Andreessen on their blog just had a post the other day from the growth team around kind of the latest metrics around growth and things for early stage companies. But for all that, when you're doing something in a dev tool space or AI infra, there's a lot more subjectivity to it ultimately. And that's why we're trying to make sure that we know where's the market going, where do we think we can help the founder create a compelling narrative, both in terms of obviously them having the vision, but as helping guide what are realistic proof points they can achieve with this seed round. Right. And I will say, Peter Walker from Carta has great data that I think has been a net positive for the ecosystem. The time from seed to Series A is definitely increasing. Right. Yeah. And we've never been of the mind that you can buy product market fit and just dumped oodles of money on a seed company. So we've always been more of the craft of seed and helping them understand what are the learnings from these different ICPs we're targeting, which is the one to try to go after. How do we then close these deals? And with time taking longer, I will say, something that comes to mind is, all right, more folks are doing pre-seeds now and our seed round's getting bigger. So something I'm grateful for is as we're navigating this AI wave, as we're navigating longer time between seed and Series A, being able to support those entrepreneurs to see through that vision. So even if it's big and audacious, which we frankly want, we can help them line up the proof points that they can raise a strong Series A on their own terms.
Interesting. So a couple of things, I guess, I'm trying to think. Actually, what do enterprises care about? Like, in terms of like what are they thinking about right now? And also, I guess the footnote to that question is like my understanding, at least of the data and anecdotally, is like sales cycles for enterprise, like budgets have contracted, right? Except for the one category, AI, right? Like it's not wrong to say that it is a much tougher sales cycle for tech companies, especially in enterprise right now. So I guess with those 2 points, like what do enterprises care about, and what's it like selling to them at this point in time?
So for the first one, the answer is a lot, which is why as an enterprise fund, we're not worried about like running out of opportunities, but it's just, there's a lot of nuance, right? Like if I take security, what was selling a year ago, right, which was maybe something more general AI framework, now it's around agentic work. And then when you think about different parts of that, of the organization as a whole, you break down identity versus the SOC versus vulnerability management. Like each one of these is having sort of a renaissance of how much can we automate, how much can we either fully do a button to click that solves something or remediates an issue or does some sort of patch, versus, all right, where should agents show us their work, but then keep a human in the loop? So what we try to do a good job of is honestly just sharing our thoughts between the Workbench blog, between LinkedIn, because there's so many areas that we cover. There's so many areas of opportunity that Fortune 500, Global 2000 and beyond, where they need solutions. And, as an example, Priyanka, my colleague, just had an agentic security focused dinner with just a tight knit group of like 6 Fortune 500 practitioners yesterday. And they were talking about, I was just reading her Slack notes this morning. How are we thinking about identity when it's agent to agent, right? What sort of permissions do they have? What sort of monitoring do we need? How do we think about bridging Active Directory that we have on-prem with different other protocols out there? What if part of the org is on Okta, right? Like, there's just so much nuance when you actually go deep. And what's cool is, again, ultimately, some of these areas end up being massive opportunities for startups to build.
So I want to break it into 2 parts. I guess, what's the call for startups then? Like if you said, okay, here's, I don't know, pick 3. Like here's the thing that enterprises, their pants are on fire. They want it. They need it. They're interested. Like what are those? Can you think of 3? Security obviously seems one, and just like, identity protocol in the age of agents. That sounds plausible to me. Yeah.
What's interesting right now? The other one I would say is not a specific one, but like to answer how Workbench, if you're ever interested in seed funding from us, is thinking about AI. We're also spending a lot of time in more vertical AI opportunities, because if we think about AI infrastructure, candidly, some of those seed rounds are bigger than our entire fund. Right? Multi-$100-million raises from the gate, out the gate, for a researcher or someone that leaves OpenAI or Anthropic or something like that. So we know what game we can play and where we can help and what, is just not for us. So we do have, though, companies.
Zuckerberg offered to acquire Random Walk for $12 billion before Scale AI went for 60. I just passed. So, yeah.
You stuck to your knitting. You're like, I'm staying in the
close. Yeah, absolutely.
But so for us, like what's really cool is we can find founders that might be quote unquote like off the beaten path in the sense of they're not from Stanford and they didn't work at like Uber or Airbnb or whatever the last hotness was in the the infra world for the last generation of founders, and say, okay, do you have a unique vantage point, some unique domain expertise, and then can you ship and show it, build in an area that we care about and know about, and then that's a perfect union. So we've got several companies. We just announced Ardian, for instance, which was actually incredible founder market fit, where 2 financial service execs are building basically a platform for agentic building within the enterprise. So you can think of it like a UiPath or like a Pega, but for the agentic era. And not only did they build a platform where you can build your own apps internally that is durable and scalable and secure for the enterprise requirements, but they launched with pre-built apps because they had built the first automated trading system on Wall Street. Prashant, the CEO, had also gotten a PhD from CMU. He also worked at Google for since. So like this team actually is a little bit more obvious than the example I'm saying before, where it's like great founder market fit.
You worked at Google. It sounds like a huge outsider.
Yeah, we spoke the same language, and they speak the same language with the customers, which is really cool. But for some of the other ones that I guess are more in the vertical camp specifically, we have a team out of Data Robot building an AI-powered credit rating tool right now. And what's really cool is they're in New York. They've been to our broader events before. They're in, so many touch points through the community, and we were able to get going with them rather quickly. We have something getting announced soon in the automated investment valuation space for real estate, right? We historically haven't really done a lot of real estate, but they're going after the software Argus that just totally coincidentally I'd worked in before. The why now is they can actually automatically extract information that comes from things like rent rolls and investment memos. They have feature parity with Argus to do the full analysis, but what's different now is you can now ingest 100 deals at once and pick the one or two that you want to focus on, layer on your market data from internal systems. And once that is your baseline capability, there's a lot of cool stuff they can do in the future. So the ability to just find these things either earlier or just understand it maybe differently than others, help them build the proof points for ultimately hopefully a strong Series A, that's the game that we like to play right now.
So what's been the worst, enterprise thesis? Like, where has enterprise gotten the most wrong over the last 10 years? Like, what was something that they were super hot about and turned out to be a total dud? The metaverse, something else besides that?
Man, honestly, there have been plenty, right? I mean, you joke, but there's been times where they thought AR would take over for meetings and things like that. Various notions of what social media would do for them, for their businesses, more from an internal perspective. I mean, there's been a ton, to be honest. There's so many initiatives that get launched and built and hyped and then ultimately don't pan out. And then obviously we also, we try to, as a seed fund, have these themes, and some of them work, some don't. That's the nature of the beast. But the real key part is just there's a method to the madness, so to speak. Like with our model, for instance, we're using those themes as sort of a North Star. And not every area can the Fortune 500 give you where the future is going, right? If we take something like dev tools, it's actually going to come maybe more from a Silicon Valley mindset, just realistically these days, or sometimes academia in the case of some of this stuff happening in AI. But trying to just triangulate those different data points of where we think the puck is going to then have an informed point of view, share it with the world, and then try to attract the best founders. That's really the playbook that we try to run over and over. And 12 years in, I'm proud that we just keep doing that. And then, in today's day and age where things are moving faster than ever, making sure that we can just, especially on things like the application layer, get informed points of view quickly when we're meeting interesting people, at the pre-seed stage, so that we can be ready to pounce when relevant.
Got it. Sorry, so let's talk about the companies that have already been funded, like portfolio companies, to the extent you're able to share. If they're not building AI, what's it like for them? And then sort of, again, leading question, because my understanding that what it's like for them is that it's brutal right now. They're just, budgets have been tightened, and if you're not focused on AI and margin expansion, cost cutting, then you don't get the time of day. Is that fair? Is that over-determined? What do you think?
So you just actually put an interesting nugget in there. So on the whole, yes, if you are AI, it gets more doors open. But actually, even within AI, there's so many different, depending on the company, either a center of excellence or some committee that is multi-stakeholder. So for all the hype, yes, code gen tools are ripping, right? GitHub Copilot is in every single company. But once you start going a couple layers deeper, it's not all roses, and there is a little bit of difficulty in navigating. Now, some companies are clearly breaking out, so it's just you got to play the game and do it right. For non-AI companies, though, one of the comments you just asked in the question was if you're tied to cost cutting. Things that can drive automation, even if they're not AI-based, are seeing good pull. Things that can drive cost cutting itself, right, in a variety of capacities, are seeing pull as well. Because in today's world, if you're a larger company, you're trying to move quicker, you're also trying to do more with less. You're also worrying about your earnings.
Yeah.
Every quarter. So that is top of mind right now for a lot of the large companies that we talk to, and it drives a lot of the adoption for early stage companies that we work with. The last thing I'll throw out, though, is we have a whole crop of companies getting great pull, but in just different areas. So Jess has a company, GovWell, and it's not an AI story right now. They'll build some capabilities in, but they're serving local municipalities, helping them go after a $20 billion incumbent, Tyler Technologies, who themselves have kind of botched their cloud move, and it's just very clunky software, and they're bringing a beautiful modern user experience and software that works, and they're getting incredible pull. And that's just a solution to a problem out there, and they've got the right why now, which is a lot of these folks are sick of paying tons of money for, basically the DOS equivalent of software.
Yeah, and right, municipalities are notoriously easy places to sell, but if you can improve their bottom line, especially now, that probably is attractive. Is there a public company, a public enterprise, software company that is the gold standard, that comes up, is ServiceNow or I don't know, SAP? One of these is just this is like the hardest to displace or the most recurring, like, no, we've got a great solution for it or something like that?
I would say ServiceNow increasingly touches so many different parts of the enterprise, so that's something that comes up. Like, something like a Salesforce, like, where they play, and if you're going to go after them, you're probably not going Fortune 500 first, right? You're going to go after startups and scale. But ServiceNow can touch everything from security to, different parts of the IT org, and as they try to grow with their AI story, that's something that people can definitely butt heads against.
Yeah, and I guess like another way of putting the question is like when founders come and give you a pitch, it's like, okay, this sounds great, but how are you going to displace X? Who is the most frequent X, if there is one?
It's funny, we don't actually think about it that way always, because part of when we have a theme, we already are either excited about, if I go back to Cockroach Labs, basically like a decade ago, the ultimate goal was displace Oracle and build a global scale-out SQL database that was resilient. Some of the early use cases were actually about greenfield opportunities, but then they've actually taken on Oracle and mainframe use cases and whatnot. So that was what excited us, that there is kind of a kink in this armor to go after. Now, we're not usually having that kind. Yes, stuff like that comes up, but it's more so out of excitement, like, hey, how are we gonna, what's the right wedge? How do you think about go to market? Do you go after them from day one, or do you kind of build durability and scalability into your platform with mid-market, and then bang, by the time we're going after Fortune 500, it's a no-brainer?
Yeah. Interesting. Yeah. So like, right, in other words, sometimes it's good to be ambitious, and sometimes like you can shoot for white space such that it exists. I want to shift gears a little bit. Something we were talking about before we started recording, but I want to get to it is like, again, it comes back to the current climate and the cohort of companies that have already been founded and been around for a while. Like, I've maintained the hypothesis, both backed by actual data and some real data, that there is a class of company out there that has raised a bunch of money, that has found some product market fit, and may even have charted a path to sustainability, but is no longer a hyper-growth company, and it is maybe doing 100, 200 million in revenue, which is, again, nothing to sneeze at, especially if but they're not, and like that is a fairly large part of the ecosystem right now. So I guess the question is, A, is that true? Are those companies out there? And B, like, what is going to happen to them?
Yes, there are a ton of companies out there that meet that profile. They had scaled, during the growth at all cost era. A lot took their medicine and cut burn when ZIRP ended. But what happened, and then some just ultimately didn't have a business model without that cash, so that they died. But there is a huge chunk, and people throw out the zombie corn descriptions and whatnot, but what's really scary here is this. Or, the last couple of years of AI growth and whatnot, it was, okay, can they get to cash flow positive? Can they actually get really profitable and start seeing maybe even EBITDA margins improve and things like that, right? And to your point, that gets exciting if it's like, hey, maybe this becomes like a PE universe, and on the margin, there's different multiples that can expand and whatnot for this universe, assuming that there's a decent growth rate. Here's what happened though. ZIRP ends, AI takes off. So not only are these companies now growing sub 10%, and many of them are even having decent, like negative growth. So they're losing
revenue growth, earnings growth.
Scale they're losing revenue every single year. But this isn't in a vacuum. What else happens? Their management team is seeing all these AI companies rip, and they probably had been a part of a lot of times good hypergrowth. So they're getting poached now by the next guard of AI companies, maybe even at earlier stages with good, compelling offers. So the management team breaks that had a lot of that institutional knowledge and know-how for that specific business, right? Backfilling those companies is going to be hard because think about the talent that you get.
That's interesting.
And then the real point of AI is a lot of those companies now are themselves going to be disrupted. Either between it's tougher to sell because you don't have necessarily a real authentic AI story, but number two, you may have an AI native competitor that is eating your lunch.
Right. So like the big janky.
So when you put that confluence together, like what happens? There's a lot of pain coming.
Yeah, that's interesting. So first of all, I don't think anybody's ever said that before, that like there's actually a brain drain problem going on where like, following the capital flows. And also I assume the other part of it too is just like if you're an executive and you're realistic about the value of your equity at that point, it's just like, there's a comp issue too, putting aside like the buzz. But so you put it like on the enterprise value of the companies themselves, right? Okay, it's, it's like decaying revenue is certainly bad, and so like in some ways you're saying the enterprise value there might be closer to zero just because it's just like these companies can play out the string for a bit.
That's the scary part, right? It's not even a question of, okay, you had 100 million ARR and you were valued at 2 or 3 billion. It's actually like, can you sell and get preference back, right? Because everyone knows it's not worth 2 or 3 billion anymore. But the question is, how many hundreds of million did they raise? Did they raise 200? Did they raise 500? And is someone going to pay 1x revenue? Like when you're starting to shrink, will anyone even want it? But let alone, like, you're not getting 5 times, you're not getting 3 times. Yeah. So who buys it? Who catches this falling knife? What, like maybe someone says, oh, I'll AIify it, it'll be efficient, I'll shrink it even more. That's a pretty risky bet, because a lot of these are in categories that aren't necessarily durable to protect themselves with like some sort of new product offering that's like AI native, so to speak.
And so, so some portion of these companies, it's just like the concern is they're basically worth close to nothing, just because it's like, yeah, they're declining and eventually. But is there some chunk of them that are clearly worth something insofar as like they're maintaining revenue, maybe they're growing it slowly, and ideally, they're better than break even. I don't know, like maybe they're growing earnings 5% a year or something like that. Like there's clearly enterprise value there. Are those companies? A, do those companies exist? And B, like, are those companies? Is that just like a PE? Like, is it just like, there's nothing unusual about that? PE will buy those at some point, or is it like, no, those companies are stuck because the equity's so underwater that the incentives are all, everybody's misaligned, so it's just like, let's just let them play out the string or something like that.
Yeah. Again, I'll caveat like this point is like just my opinion, because again, I'm a seed guy, so I don't even play. I don't see enough of that. I'm talking mainly just macro stuff I see, conversations with friends. But yes, there are certainly some that do have real businesses. They just got hit when they had to switch from growth at all costs to profitability focus, right? So I think by and large, majority of the unicorns were in the former camp we talked about, where there's probably a lot like zero equity value or near zero. But there is a handful, of course, that were right place, right time for a moment. But then again, the brain drain, AI, etc., has really hurt them. I think a good chunk will take their medicine and get acquired by bigger platforms. The question, and those could be equity only transactions. It could be some consolidation stories when it makes sense. It could be some multi-billion-dollar private company that still has momentum being strategic with tuck-ins, and ultimately the tuck-in is a rather large base but shrinking, but maybe it brings a product capability that they can now sell a bigger story to someone. So I do think a lot of that has to happen, and I think a lot of the VCs know that's going to happen in the growth stage, but they've just been kicking the can down the road because the other thing is fundraising's harder than ever for multi-stage funds. Like, you have people that never used to have to travel anymore from established firms, like kissing the ring, going to the Middle East and whatnot, because we haven't had enough distribution. So it's just hard to raise, So why would they take marks on some of the historical portfolio companies that may make their lives even harder? Yeah. Again, so this is just conjecture, but it's some percent of companies from that generation are going to still work and go public. Some are going to get acquired for stock or small return of a partial return of preference, but then a lot are just going to be act like zombie is probably the best description, and we'll see if and when they just
fritter and waste,
fizzle away.
I want to come back to the fundraising point in a second, but I guess, is there some class of these companies that or is there somebody out there saying, look, it's not a tuck-in, I want I think these are good companies, but they're not hyper growth companies, and I just kind of want to rescue you from those, from those expectations and either recap it. Is that is anybody out there trying to do that? Is that happening, or is it just not feasible? Like, because if part of what venture does, and certainly at the seed stage, is these are long out of the money call options, right? Like they're fairly binary. Like we're going to turn over the cards, so to speak, and either you're going to find an opportunity or you're not. Like, it seems like a lot of the expensive work has been done for some of these companies where, yes, you've turned over the cards. There is some opportunity there. It's not a hyper-growth opportunity, but it doesn't mean it's not a real business. And now go build a real business, which I think a lot of founders who sort of like, once they're off the, once they kind of get religion about how few really true hyper-growth companies there are and how hard that is. And that seems like an appealing value proposition. The issue that I've seen is just like, the incentives are all messed up because the founders' equity and all the early stage investors, their equity is now underwater for like later stage preference or something like that. But I don't know. Is that or is that just like, am I just describing private equity and this is nothing new? I don't know.
I understand what you're saying, and I've heard a few situations of people launching like special sits funds trying to say, I think it's earlier stage, but we'll buy you at X we'll take it off the VC's hands. It's just clearly not working. We have some thesis in that category, or we have some machinery where, I'm going to make this up, but it's like, we know how to do the marketing with a person in how it's like maybe like a mini Vista playbook, right? Like we have best practices around sales and marketing. We'll do it quite efficiently and then just change the cost structure of it and infuse a little bit of growth and make it compelling. You know, I don't have personal experience with those kind of companies or firms, but what I do know is people think about where are there consolidation opportunities to connect different parts, right? Especially if you're serving like, you know, an SMB or mid-market, could you maybe bundle together different solutions? And then if you could get them cheaply, is there a story there? When you're talking about, even though the 100 million plus, 200 million plus, I do think that is more of a PE story. And I think, you know, to take a legacy business and infuse tech, which was like the move for the last however long, when it's tech native from the outset, but maybe not AI native, this is my big question, like what happens there? Because it's like, how much efficiency can you really get? They might have just had fundamentally broken R&D, or the market may not have been there, or the product they built was cool in a ZIRP fueled economy, but ultimately not needed. And it's like a Ferrari engine when, you know, you could have gotten by with something more basic. So like for strategies like that, I think you really need to be opinionated on the markets and be very precise in where and when you would operate, as opposed to a more blanket, you know, I'm going to offer half X to 1X revenue and take it off your hands.
Yeah, I guess like part of what I'm pushing on, I think, is like, you know, in some ways one of the realizations of, say, like mid-cap, you know, small and mid-cap investors, like the small and mid-cap value trap, right, is there's been a long time for like, oh, you know, these are small and mid-cap companies are underpriced. That's where, you know, but they're good companies and they're returning profits and things like that. Like one of the realizations has been is like the reason that these companies are underperforming in some ways is because the management teams really like being executives and not necessarily like, you know, increasing returns for shareholders, you know, and they're happy, and like they're happy to just kind of hang on and run these companies and you know, maintain the status as CEOs and like, you know, clip a high salary. And not that that's a model you want to replicate, but like there's so much the expectation of just like, okay, you're going to raise some money and then some, you know, you're going to grow and then you're going to exit. Is there some other zeitgeist that's actually like, no, I like running this business. It's really hard to, you know, build one business, let alone two. And, you know, the preferred outcome for me is actually just like, I just want to keep running this business, you know, and being profitable. And maybe it's not, again, like maybe it's not Google or something like that, but like, is that a thing, or am I just making that up?
Yeah.
I'm making it up.
Well, let me ask you this. What small cap or mid cap industries are you talking about? Are they in tech, or are they in more traditional industries?
It's a bit of both. I mean, there are some software companies, like, again, like almost every company sort of calls itself a tech company, but, you know, it's a bit of both, I think. You see it in REITs too, but I think you also see it in some of these, you know, underperforming software companies or things like that. Like, in other words, like...
I think... go ahead. I was just going to say, I think for the more... It's just a different story if it's a more traditional industry that could still be infused by some operational excellence, versus a tech first one, which again also needs, to your point, to have like focused operators, not people that are just kind of like out to lunch. I just think the latter camp of a tech company that is public and old software has a customer base that they kind of clung on to, maybe slowly shrinking, or maybe it's just like holding on. That profile, I think, is going to be fundamentally disrupted by the current generation of companies that can just offer a seismic shift benefit in capabilities and user experience and probably reduce cost. And historically, these folks, they kind of own that customer and they could hold on to them, but the dam is breaking, and I think they're actually going to be the hardest hit.
Interesting. So you're just like bearish on that hypothesis in general. It's just like it's no longer good enough to just to know the customer and, you know, be good, you know, bitching ain't switching kind of thing. Like, be good enough. Like, you're just not going to be good enough anymore. The gaps are going to be enormous. Interesting. It's brutal. Yes.
Oh, man. We are very, very, very grateful to have raised from an incredible group of RLPs. And one of the things I talked about with my co-founder, Jess, and I'm actually publishing a blog post on, is just really lessons learned. Because there's two camps, right? There's right now a lot of sub $50 million funds, solo GPs that are trying to get out and going. They either left bigger platforms, they were operators, and a lot of that emerging manager money is just harder to come by right now. And then on the high end, you've got the top tier brand names that are doing their thing. But if you're like not even tier 2, but like tier 1.5 and trying to grow and trying to play in AI, I just think it's a lot of work, right? It's nothing new from here, right? You have AI is a bigger opportunity than ever, but you also at the same time have fewer distributions right now, so there's a liquidity challenge. You have stuff that's potentially facing some of these endowments. So it's just people going after a net new LP base, often in the Middle East, but in other parts of the world too. And I do wonder what happens there. I mean, look, personally also, like, I hope some of our late stage companies manage to exit as well. So I think the ecosystem is waiting for it. I do think, you know, some of the recent activity bodes well. You know, Chime went out. You've had others recently. Hinge had a good IPO. So I think slowly but surely, some of these are going out. The interesting part, though, is like, you know, everyone was like, when is Databricks going to go out? When is Stripe going to go out? And I just think the changing game of just like people dumping hundreds of millions and billions into some of these private companies now delays that. So I think it changes the calculus for, you're not going to wait for the big dogs to go out. You're going to have to find your own timing and just do it.
Yeah, no, I actually meant fundraising. Right, yeah, right. So fundraising for the GPs. But I suppose, like, you know, I think it seems fairly clear that putting more money into VC does not then create more venture backable companies, right? Like, in other words, the bottleneck is not necessarily capital flows. There is a fundamental scarcity of how many good risks there are worth taking. Or is that wrong?
I think we're going to see more companies created than ever because, you know, the same way when cloud came out, you didn't have to buy a server. We've all heard that story, blah, blah, blah. And actually more VC ended up coming in because even though it was cheaper to start, there was more capabilities and you got higher ROI on the dollar. I think the same thing is going to happen with AI, but you might see more seed strapping first, right? Where people are just building and getting enough metrics and maybe get going. You'll see people taking institutional seeds, but with more clarity of vision and already having more proof points of what exactly they want to build, and here's the rocket fuel to help you go. You'll have people, as I'm saying, launch out the gate with multi-$100 million financing rounds, and it's like an army of talent ready to go. So I actually think everything AI is a net positive for the venture ecosystem. I think we're going to just see good returns on the dollars on an investment basis when not in aggregate, not saying all VC dollars are going to be positive, but when things are working, you can get a good ROI on that in your company. And, you know, it'll be up to you to figure out those ROI calculations and do you actually have product market fit, et cetera. But I think it's going to be a net boon. But I do think also, you know, you Google like Series A crunch, tech crunch over the last decade, and how many times have we seen that as a headline? I think the bar is going to continue to rise in turn of what it takes to raise A, B, you know, become an exited company.
And I think, like, from the GP's perspective, I think that, you know, I think it's becoming more conventional wisdom or being said out loud more commonly is just like there is, you know, the biggest platforms have raised the most money, and the sense is like they are competing up and down, you know, the fundraising cycle. Like they're at seed, they're at late, like they're doing their multi-strats, right?
Yep.
And you're not going to beat like, you know, you don't want to be competing with Andreessen or Sequoia or anything like that. So what do you do? Like, in other words, do you fish in another pond? Do you draft off their deals? Do you try to predict what they want?
Yeah.
Yeah.
I think that's such an interesting question. And we were talking with an LP the other day, and they asked a very similar one because they're cost insensitive. So if they see something, and candidly, I'd say probably bigger for multi-stage is probably our more direct competitor than other seed funds, especially in New York City. Here's my take on it. I think they are looking for a unique profile that is not always obvious at seed. So there's going to be some founders where they fit the match. Again, did they do the Stanford, the Google, the Uber, whatever engineering these days where they had Anthropic or OpenAI or Mistral, whatever? Like, if there's someone super well known there, they're going to own it. They're going to give them whatever it is. Is it 5? Is it 20? Is it this? Out the gate. That's not a game Workbench has ever played. And if you are a seed firm that was more momentum driven and maybe more like of an index fund doing 50 deals, 100 deals, I think your allocations are going to struggle potentially. I also think your returns might get hurt. Here's something that I haven't heard talked about yet. If you were used to putting in $1 million into just like a basket of companies, if seed stage companies are boosted up in price because the multi-stage just need the option call more than ever. And we've always said, you know, multi-stage at seed can be an option call. But if the competition set is driving prices up that much, where you're now maybe getting 25-40% worse pricing than you historically were, and so many of these are moving so fast that maybe we'll have even more of a breakage and death rate, how big do those outcomes have to be for that seed fund that's doing that more generalist strategy? And how do they play in that game, and how do they alter their criteria, right? And they would say, well, the outcomes are going to be bigger than ever, the founders are going to be better than ever. But I think from a portfolio perspective, it's actually hard. Where we're doing is, in a way, fishing in a different pond, trying to find people that might be lesser known, that speak the same language as us, that want to work on all things go to market from day one and hopefully build a durable company. So again, yes, sometimes we just lost a deal the other day to a big multi-stage that they said they wanted a seed fund and then ultimately they went multi-stage. That happens, but there's plenty of others where...
Or did you lose it on?
It was in the AI world, and I think Coastla's just ability to fast follow with a ton of capital, if it works at the A, gave them the momentum they wanted. And look, that's going to happen, and that's okay. There's some where from the outset they say, I want to raise, like what is the YC class? 2 on 30, 2 on 40, and it's like we can't get ownership and it's too high. Like those are the clear no's where we don't even fish. What I love is when we compete against other seed funds, and then we're like, hey, here's our view on the space. Most people don't even know that market. Here's our view on go-to-market paths. Here's our view on how we can help you. And by the way, here is how we're going to help you as part of diligence. And those just end up being a layup, right? So we know, and we have the confidence that there's more opportunities than ever. We're going to have more heartbreak along the way, right? In early 21, we launched our third fund, which was 125, first quarter of 2021. One of our first investments didn't raise an A for 3 years. They are ripping. And that was like such a fit. We'd known the founder forever. They're in New York. We speak the same language, etc. So this company is Alt-Z. It's in the permission space. So they're building basically an authorization layer inspired by Google Zanzibar for scale-out permissions. Serve some of the biggest companies in the world, and incredible founding team. They've done an amazing job growing and scaling so far. But what's funny is that one, it was just such a natural fit to work together, and General Catalyst did the A there 3 years later. For every one of those, we have during 21 like 10 that were like, we thought that we aligned with the founders, we thought that we were in a good place, and either pricing was just so misaligned or a multi-stage swooped in and just ultimately got it. So we're prepared for a lot of heartbreak again this year. That's what we signed up for. Because when we do find our people and we align with the founders, we're able to dig in with them, help them, and they're obviously able to run their business as well in a way that we're aligned.
Yeah, that's interesting. So two related questions, and then I think we're up close to time. Is like I have this view, and I don't think it's entirely unique to me, but maybe it's just like there's generally speaking, there's a lack of connectivity between investors in the different asset classes, but that's particularly acute for VC, which has kind of been kept to itself. And yes, they're underwriting a different risk for a long time. I think VC would benefit from some cross-pollination and a little bit more market sophistication, such that the only product was not like extremely expensive, heavily dilutive capital. And the sort of part B to that is, so is that true? But part B is like, to me, like the upside, like there should be more, people should be more thoughtful about other off-ramps, whether it's secondaries, preferred, other structures, non-dilutive financing. Like, do you think that's right? Like, how do you think about that stuff? Like, do you see, handing off to secondaries as being is that a path that people should be taking? I don't know.
In general, as tech grows as a market and as venture grows in more prominence, just with the big firms becoming even bigger, we as an industry are and the impact that tech has is just growing in prominence, right? Versus if you look at it over decades of horizon. So my short answer is yes, 100% we're going to need new tools, right? We didn't even scratch the surface on like what happens as companies scale in the future, how many stay private, how many go public, what do exits look like, and what does that mean for the early stage ecosystem? What does it mean for LPs that have horizons that are not maybe 20-year holds, right? But should have been closer to 5 to 7 for a certain class, 10 to 12 for another class as you go earlier and things like that. So my short answer is yes. I think that maturity is coming, and as we've seen from a lot in the private equity world, retail getting more access and just technology even enabling more people to participate in some of that. I think in VC and tech in general, we're going to just need more financing solutions. There's a ton of stuff right now happening. I don't think anything's at scale yet. Like, I know everyone's talking about secondaries right now, but I'll tell you, I'll talk to a lot of our fund-to-fund LPs who have secondary strategies. I'll talk to banks that focus on it. If you are not the brand name, SpaceX, Databricks, Perplexity, there's no activity. You see these emails that like have all the discounts and everything to trade, but there's no transactions. So as much as everyone's like, secondary is the future, it's not there yet, and we need maybe other solutions to it. We need to have more systematized ways to do it. We need more information flow, right? Think about it. Private companies don't want to share their financials. So that's a huge gatekeeper right now. But, is there a day where maybe someone can do it in a privacy-preserving way, but give some sort of credit rating or things like that, and give you some sort of risk score so you know what you're signing up for on the internal side while you can do your external market diligence and things like that. That's what keeps this industry, again, interesting at the end of the day. It continues to evolve, and I do think that there will be new models explored, and, we're keeping tabs on all of it, especially as a seed fund, bearing in mind liquidity for our underlying LPs.
Right. Yeah, and in some ways it's like, for secondaries, for their secondaries, the secondary market is mostly concentrated in a small handful of companies, and those companies are not trading secondary because they have to. In other words, they're doing it because demand is so high and because they can, right? In other words, that's just. But
yes.
But for anything else outside of that, assuming the bid is not zero, it's like there has to be some reason why the secondary investor sees something or has a different return profile that the primary. Because you're not injecting fresh capital into the company. So it's like, at some point, either the primary has to say, look, I think there's still some upside here, but I'd rather have fresh capital to allocate to the kinds of risks that I'm really good at. And so, maybe, right, like, in other words, there's still upside. It's just not the kind of upside that I'm in the market for.
You want to know my take?
I do, yeah.
So I've talked about this privately with a few people, but I think there's an opportunity for someone to create a fund that goes to every seed fund. So only seed, right? Not people that do Series A, B, and say, hey, Workbench, hey, funds 2, 3, 4, give me your top 2 names that are in multi-billion valuations that you love. They might be multiples of your fund itself. So from a portfolio diversification standpoint, they're like taking a big chunk, and we'll buy that at a minimal discount, right? Because right now it's hard to transact, and if you can, check sizes are usually small and the discounts are massive. So like for some of my gems, for instance, thankfully we have a few, I'm not selling that at a discount, right? My LPs love it. We share information on the company. It's growing, it's ripping, but ultimately there is a trade-off at a certain point where it's like taking some money off the table. The classic Fred Wilson, like you take a third off once it's reached, back then I think it was like $1 billion. For us, it's like a turn of the fund. I would love to do that. And you avoid adverse selection because I'm not giving you 5 names. I'm giving you probably 2, right? And if you go and you talk to 10 seed funds and you get 15, 20 names in aggregate, and you had opinions in your own diligence, and then you can get access here, couldn't that be an interesting return profile, right? Because the key thing is always the adverse selection problem. You don't want the company that got marked up 1,000x and you're just holding the bag and the bigger idiot. Here it's like, no. I'm holding because I love this company. It's a pristine asset. I'm waiting for an exit. But if someone offered me a compelling offer, we would take it, right? So that's the game that seed firms are in today. We have a really supportive LP base that has never forced us to do anything unnatural, and I'm so grateful for it. But I have a lot of friends that were raising Fund 3, Fund 4, and the LPs are like, you need liquidity right now. I don't care what the discount is. Show me some money back. Yeah. And that's a tough spot to be in. Yeah.
And also, again, I do think also like you want to be able to deploy. There is like, sure, once you find your winners, you want to ride them, but you're also not in a slow and steady business. Your skill is identifying these extremely high vol equity options early on, and like if you can get some fresh cash to reallocate from like, okay, here's a known thing that's growing. There's still upside here, but I want to put it. I want to put it to work in the finding the kinds of risks that I do best. Like that to me makes a lot of sense.
By the way, not to nitpick on it, but it's not even just about recycling. Like I have some companies where my fund is end of life or like near end of life. We're not doing net new investments. And it's more so a function of portfolio management. I have something that is ripped. It is thankfully multiples of my fund. It would behoove me to take some off the table if there was a good price. But if there's crazy 50% discount, I'm not. Yeah. And my LPs support it. That's the key. Because you are aligned with whoever this potential buyer is, that it's a strong asset. And that is your motivation. Just being a good manager and returning capital to LPs in a risk-adjusted way. Again, like Fred Wilson and others have spoken about.
Yeah. All right. I think we're out of time. I don't know. Is there anything else? I guess what's I don't know. I'll ask the teal question. Is there a thing, like what's the most contrarian thing you believe right now, I suppose? Like what's the thing that you think that everybody thinks you're wrong, or most people?
It's going to sound cliche talking my own book, but it's how we're in business 12 years so far and hopefully decades to come is that enterprise go-to-market is a key differentiator at seed. If you can get that done right early and build the right DNA in your company, it can help you build an enduring business versus scaling rapidly and then having to reorganize everything in the future when that's really the customer base you need.
So get it right early as opposed to just slap together and figure it out later. That's interesting. Are the Heat going to blow up the team, or are they gonna stick with this?
Hey, this is a fun off-season to track. There are a lot of big names that I hope we can get one or two of to join us. I mean, I wouldn't mind Giannis or even honestly KD, depending what it would cost. So yeah, I will stay a Heat hopeful.
Screw Jimmy Butler. I take Pat.
By the way, yes. I
take Pat Riley's side. Yeah. All right, man. I appreciate it. Thank you very much. Yeah, we'll talk again soon.
This was fun.
All right.
See you soon.
Bye.